Okay, what's up guys? Long time no see. This is going to be a off-the-cuff, freestyle, no script investment portfolio update number 1. I should change this title. I started making the PowerPoint in May last month. I'm now recording it in June. Okay, this is going to be what I've done, where I'm at, what I hold, where I've made profit, where I've made loss, and just like a case scenario for you to view of someone else. You can compare your journey to mine, and just to compare, really. This isn't going to be advice because I'm not a financial advisor and I don't really know what I'm doing, but I have had some decent results. So the information that's going to be in this PowerPoint was accurate as of yesterday, which is the 16th of June. My current deposits stand at £9,104. Current portfolio value stands at £10,005. That's a £901 increase or 9.9%. And I started in October 2022, so around 20 months ago. You might think, okay, 9.9% divided by that 1.66 years or 20 months, that's about 6% yearly returns. No, that would only be true if all of my deposits were made as a lump sum right at the start. You need to understand that the money has been deposited throughout the journey. Yes, that's the first thing that people need to understand, because I'm at the beginning of the journey. So for example, you put £1,000 in a savings account that offers 5%. If you put that 1,000 in at the start, at the end of the year, you'll have the 5%, which would be £50, so £1,050. But if you're depositing that £1,000 through the 12 months, your average balance in the account would be around £500. And so you would have made about £25 in interest going off your average account balance, if you understand what I mean. So onwards. This would be, so here's my deposits, total deposits, divided by the number of months to make an average deposits per month. And this is my deposits put into an annual equivalent interest rate model to simulate what would happen if my deposits went into a savings account that offered 6% annual returns or 6% interest rate. And you can see by month 20, my £8,904 would have become £9,350. But I'm way above that, as you can see, which is a nice little thing. We can go to the next slide, and this is the same table, but for the simulation of a savings account that offered 14% interest, which you can't get. Okay, that doesn't exist. And as you can see, the end value after 20 months would be just less than what my current account value is at. So as it stands, I'm beating 14% returns as it stands. And now this could be due to my luck or skill, or it could be due to the timing of when I made my deposits. The S&P 500 and the FTSE 100 have both made all-time highs in the past 6 months. So I could have had fortunate timing when I got in and the current moment. But we'll see. I'll make another one of these videos in a year and we'll see how that changes. Currently, I'm beating a 14% interest account, a savings account. Yeah. So my money goes into 20 UK stocks, 3 ETFs and 1 fund, and 2 US stocks. And I'm sorry that my camera's blocking that right now, but about 35% of my funds go to the UK stocks. 60% of my funds go to these 3 ETFs plus 1 fund. I'm just going to call it 4 ETFs for ease of language. And 5% of my money goes to these US stocks. My UK stocks all pay dividends, 20 UK stocks, and you can see I've got them categorized here by sector. I'm going to read out the stocks. That's Aviva, Legal & General, Barclays, Lloyds, Rio Tinto, BAE Systems, Tesco, Unilever, Shell, BP, GSK, SSE, National Grid, United Utilities, BT, Halfords, Taylor Wimpey, City of London Investment Trust, BlackRock World Mining Investment Fund, and UK Wind. And here they are. Here are the sectors. I didn't purposely have this specific sector diversification, but I did understand when I was buying these stocks that I'm going to need some sector diversification just in case one sector does bad. If all of your stocks were banks during the banking crisis, you would have lost a lot of money. Onwards. So I'm going to read out quickly the returns I'm making on each holding, all my UK stocks. And after this, I'll read out the returns on my ETFs and the returns on my US stocks and what they are. So Aviva, I'm up 14%. Legal & General, I'm down 7%. Barclays, I'm up 31%. Lloyds, I'm up 26%. You can see the dividend yields below the company's logos. If you want to pause the video and check the dividend yield, please do. Rio Tinto, I'm down 5%. BAE Systems, I'm up 48% thanks to the war. So this is a stock that's classically referred to as a sin stock, a bit like a cigarette company like British American Tobacco. Tesco, I'm up 27%. Unilever, I'm up 9%. Shell, I'm up 9%. BP, I'm down 5%. GSK, I'm up 11%. SSE, I'm up 5%. National Grid, I'm down 7%. They very recently did a rights issue and kind of issued a lot more shares, which has decreased the value. United Utilities, I'm breaking even. BT, I'm up 13%. Halfords, I'm down 20%. Taylor Wimpey, I'm up 20%. City of London, I'm up 2%. BlackRock World Mining Trust, I'm down 11%. And UK Wind, I'm down 12%. Overall, I don't show it here in the PowerPoint, but overall, my UK pie, as it is on Trading 212, which you can copy, by the way. And there'll be a link down below if you want to sign up to Trading 212. It's the best trading and investment platform there is in the UK, in my opinion. Overall, my UK pie is up like 7 or 8%, including dividends, which I'm happy with. Onwards. So the 4 ETFs, one of which is a fund that I own, is VUSA, which tracks the S&P 500, VWRL, which tracks the world, the biggest companies in the world. And because it tracks the world, there is overlap because there's overlap with the S&P 500 because a lot of the biggest companies in the world are American. VHYL, which is a FTSE All-World Index, but it tracks the high dividend paying companies. So there's a bit less growth in that one, but it does pay a better dividend. And finally, the fund is JGGI, or JP Morgan Global Growth and Income Fund. And the reason I chose this was simply because its track record is amazing, and it pays a 3% dividend. Its track record in terms of growth is matching the S&P 500, and it pays a dividend. So I'm just hopping in. I know they say that past performances doesn't equal future returns, but at the same time it does. And that's why we read graphs and look at graphs. That's why graphs are important. So each of these individually, VUSA, I have 17.27 shares. My average price is 68. Current price is 81. I'm up £223 or 19%. VWRL, I have 13.36 shares, average price 101, current price 102, I'm up 17%. Keep in mind that I've only recently started my positions in VWRL and JGGI. So I've recently bought into these stocks, so there's not been a lot of time for the current price to deviate much from my average price. Onwards, VHYL, shares 26, average price 48, current price 51, return £65 or 5%. And JGGI, 250 shares, average price 5.52, current price 5.69, up 3% or £42. My 2 American stocks, as you can see here, I have 1.28 shares in Microsoft at an average price of $302. The current price is $442. That means I'm up 43% or $134. Microsoft also pays a 0.68% dividend. Apple, 1.9 shares, average price $170, current price $212, return $55 or 21%, and it also pays a small dividend. So that's it. That's the portfolio update, and I've rushed through it because this is just a screenshot in time of where I am. There's no extra context to this video. There's no advice, okay? I'm not going to pretend to know much or enough to give you advice. I am a consumer of advice, not a distributor of advice. This is what I've done, and so far it's going okay. But I do intend on becoming more well-versed and more intelligent on this subject to further increase my returns, and you can expect more portfolio updates in the future, maybe just once a year, but they'll be here. And I'm a young person and I'm tech savvy, so I can carry on recording these things once a year. Okay, there's no expectation from me for this to become an investment channel. This is just where I am, and if you're interested, this is it. So just once again to reiterate my major statistics, I'm up about £900, which from my total deposits is a 10% increase. But like I said, because that wasn't a lump sum deposit at the start, my actual returns, as I showed in the AER model, are matching a 14% interest rate savings account right now, which is amazing. I'm not sure whether that success is going to continue, but we'll see. We'll see. And like I said, you can sign up to Trading 212 through the link in the description. If you sign up through that link, you'll get some free shares. I'll get some free shares. On Trading 212, you can make an investment account, an ISA investment account, an ISA, stocks and shares ISA, which is completely tax-free. Okay, Trading 212 is a free platform to use. It's the best one. If you're new to this, but you want to have more money in the future, you've finally realized that having your money in a current account is just the death of all future savings, then make a Trading 212 account and just start with an ETF. Start with VUSA. Track the S&P 500. It makes like 10% returns every year on average. And good luck. Yeah, thanks for watching the video and good luck. Comment down below if you like a stock, dislike a stock. If you want to see a certain type of video, let me know. I'm going to stop rambling. Thank you for watching the video, sir, and good night.